Hey everyone, welcome back to Corporate Decoder, the place where we uncover the secrets hidden in plain sight within corporate filings. Today we've got a filing from Cyngn Incorporated that you absolutely need to pay attention to because it is about something that happens when things go wrong with the numbers. Imagine you put out your company's financial report all proud of your numbers, and then oops, you have to tell everyone. Sorry, those numbers are wrong and we need to fix them. That is pretty much the headline here with Cyngn Incorporated. This is called a Form 8K filing, and it is like an urgent announcement to signal that something big has changed or is about to change, and it is usually not a good thing when we see this particular type of announcement. So what happened? Well, on the 4th of November of 2025, Cyngn's leadership team, the board of directors, specifically the audit committee, which is like the financial watchdog of the board, got together. After some serious discussions, they concluded that the company's financial reports that were previously released just aren't reliable anymore. This includes their big annual report for the year ending the 31st of December 2024, and also their quarterly reports for the first 2 quarters of 2025. All of those reports, the ones you might have looked at to understand how the company was doing, need to be thrown out and redone. The reason they are saying you should ignore them is because of an error in how they accounted for something called Series A warrants and Series B warrants. Think of these as special contracts the company made that affect its finances, and they got the accounting treatment wrong. This error means that investors should not trust any of the numbers that came from these reports, including any earnings releases or other announcements that talked about these same numbers. So how big was this mistake? The company estimates this error caused a significant jump in what they owe for these warrants, or their warrant liability to be specific, an increase of about $12.7 million. And because of that, their already reported equity balance, which is basically what the owners of the company really owned, took a hit, a decrease of the same $12.7 million. This also messed up how they show their cash flow on a statement, so money that should have been shown as coming from or going to financing activities got mixed up with operating activities. On top of that, they now expect to recognize a loss of around $2.3 million related to how these warrants were issued in the first place, and another $1.7 million in costs associated with this whole deal. This error wasn't just a little oopsie in the annual report, it also meant a big significant change to their quarterly reports too. They estimate it added about $402,000 to what they call additional paid-in capital, which is money shareholders have invested, but it also caused their reported net loss to go up by a substantial $3.7 million. Now, the good news in all this is that they said this error did not affect their total cash on hand, their total money earned, or their core business performance, which is a relief. But still, you want your financial statements to be as accurate as possible. And it gets worse. Because of this mistake, the company's management has now identified another serious problem with their internal controls. These are the systems and processes a company has in place to make sure its financial reporting is accurate and reliable. They found an additional significant weakness in how they handle financial reporting and disclosures. This will be explained in more detail when they file their updated annual report. To fix this, they plan to bring in an outside expert, someone who really knows their accounting stuff, to look at any complicated financial deals they do. They expect to have this whole issue fixed and tested by the first quarter of 2026. That is quite a ways off. The audit committee has already talked about all of this with their independent auditors, CB's CPA's PC, basically confirming the seriousness of the situation. Cyngn is now working hard to get their amended annual report filed, which will include these corrected financial statements. They also plan to include the restated financial statements for the first 2 quarters of 2025 in their upcoming quarterly report for the period ending the 30th of September 2025. Now, for something that might affect company executives, their compensation committee looked at the company's clawback policy. This policy basically says that if executives messed up and caused financial restatements, certain bonuses or compensation might have to be paid back. In this case, the committee decided this particular restatement would not require any compensation to be taken back from anyone. So it seems no one has to give back any of their pay because of this particular error. Now, here is a standard but important part of these filings called a cautionary statement. Companies include this to protect themselves legally. They are basically saying that some of the statements in this report are forward-looking. That means they are about what the company expects to happen in the future. Words like believes, anticipates, estimates, plans, and expects are common here. They want to be clear that these future predictions come with risks, and things could turn out very differently. They mention that things could go wrong that could make the actual results very different from what they are expecting. Some of those risks include delays in filing their required reports, whether other accounting problems might pop up, and any negative impact on their business because of these new disclosures. They are strongly advising you not to put all your trust in these future predictions. There are a bunch of important factors that could really change things, and they point to the risk factors section in their annual report for more details. They also state they have no obligation to update these forward-looking statements even if new information comes out. And finally, we have the signatures. This report is signed by Natalie Russell, who is the Chief Financial Officer. This just confirms that the company is officially submitting this report and taking responsibility for its contents. So what does this all mean? This filing is a big deal. It is a clear signal that Cyngn Inc. has serious accounting issues that have already led to previously issued financial statements being unreliable. The fact that they've identified a material weakness in internal controls suggests that their processes for ensuring financial accuracy need significant improvement. While they are taking steps to correct the errors and bring in outside help, it does raise questions about the company's overall financial reporting discipline and the effectiveness of its oversight functions. The good news, if there is any, is that the core business operations impact seems minimal, though the financial restatements themselves can erode investor confidence and potentially lead to scrutiny from regulators or even legal challenges. The decision by the Compensation Committee not to claw back pay is also noteworthy and could be a point of discussion among investors. Overall, this is a situation demanding careful watching as the company works to regain its footing and provide consistently accurate financial reporting. Alright, that is our breakdown of Cyngn Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think they can truly fix these issues and regain investor trust? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more corporate deep dives. Don't forget there is a link to our Discord community in the description where we discuss these things and more. Thanks for watching, and we'll see you next time on Corporate Decoder.